Hi, my name is Felix Fry.
And I'm Marco Rajnica.
We're here to find great trading opportunities that target 150 to 400% returns. And you? Well, you're going to help us do it every single day. So welcome. This is the Winning Picks Podcast. This podcast is for educational purposes only. OptionsGeek LLC is not a broker-dealer. OptionsGeek LLC, Felix Fry, and Marco Rajnica are not registered investment advisors. Keep in mind, options involve substantial risk and are not suitable for everyone. Please consult your own investment advisor before doing any trading. Make sure you read the full disclaimer at the end of this episode. Marco, what's going on? How are you?
Hey, good. Let me just set this up. All right, there we are. Cool.
Good.
Turn my lights on. Ah, nice.
Good holidays?
Yeah. How's everything been for you?
Good. Everything's okay. Let's
Awesome.
get cracking. So what's market's up
Yes.
like every day, and I see a lot of continuation of what we've been talking about. So, but what are you seeing? Why don't we start with what? Why don't you pick a few things?
From the market, or I was just gonna first say.
Go ahead.
Right. I was first going to say that we appreciate all the feedback from the Robinhood video. A lot of people liked it. We've got a lot of views, and we want to thank you guys. And for all of you that haven't seen it, please check it out. It's really great. And I want to announce a different series that we're going to have this week for New Year's, Wednesday and Thursday. We're going to have 2 parts on each day, and it's going to be all about IV and other parts of volatility. All you need to know about it to be able to trade direction, as well as, going in depth more into the Robinhood video about volatility traders, how they trade, and what happens on behind their trades. So that's what we're going to be going over, and I think you guys are going to enjoy it. But first thing, Felix, before we dive into the market, I had a question for you.
Sure.
And it was regarding entries and exits. And
okay.
If you have any tips for people or advice, because I'm sure a lot of people ask you this, and I also wonder myself, what's the best way to enter into a trade? Is it to wait? Is it to get in immediately?
Sure.
Exits and stuff like that?
Sure. So that is part of the equation that is going to be unique to most people, right? It's the ability to find that groove where you understand that if you jump at the price, if the option price goes up that morning and you jump at it, sure, you may catch the move, but your stop loss, or some level of stop loss, wherever you decide that's going to be, I suggest 50 to 60%, but wherever you decide that's going to be, that is now higher. So the entry actually dictates a big part of the way the game for that particular stock is going to be played. Now, when the trade, when you look at the trade in the morning and you're thinking about getting in, I would avoid market orders on the open. You see some of the games in the Robinhood video that we just put out. You see some of the games that are being played. So there's other games as well on stock. So just sort of not do the market on open order. You can get ripped off pretty easily there. But I would also perhaps try to find or try to look at what the market is doing relative to the stock. So if the market is up significantly, does that mean that the stock should be up significantly? It probably should. You probably don't want to trade these opens where the market's gapping higher or gapping lower. It becomes difficult to get good pricing, first of all, and also you really want to make sure you don't get caught where there's a gap higher, you reach, and then it immediately comes back down. It happens a lot, especially in these high volatility names. It'll happen in the mornings between 9:30 and 10 o'clock. There will be these highs and lows that are absolutely insane, and you're trying not to get stopped out at those moments, and you're trying not to get to enter in those critical moments, unless it's if you're trying to buy an option for $1 and it gaps down lower and it's because the market is down in general, then that's different. So context does matter, right? There's a lot of things going on, but let's just say there's calls and you're looking at calls. The market is down. If you're looking at, there's a good here. Let me show you my chart here. I look at something called the momentum. This is the momentum factor ETF. It's an ETF, but it's just showing you, it's an ETF of all the big momentum stocks. Okay. And, if you're looking at a momentum stock and momentum stocks are opening down that day, then, then it's not necessarily anything specific to that momentum stock, to that stock. If, the market is down, momentum is down, and the stock is down, well, then, if you're looking to buy it for $1 and it's trading 80 cents, that's probably a decent entry for that first entry. It comes off a little bit more, you can buy the second one. Now, if it keeps going, then I would just hold off until it actually reverses. But, that's where context does matter. So you basically have this momentum, giving you some direction. If it's a value name, I tend to look at this, value, iShares MSCI value factor ETF. Same thing. If you're looking at something like a Coca-Cola, a Johnny John, I don't know if Apple's even value anymore, but you're looking at names that have earnings that are thicker stocks that they're more like Dow stocks. Then there'll be essentially some value in there, and they're more in this type of index. So if these names are up, then you want to sort of see the relative movement between the stock you're looking at and sort of what's happening there. So this is where I try to get everyone to at least focus on what is it they're buying. Usually these things are growth names when they're playing in options. But if the growth names are not doing so well in the morning, even though the SPY is flat, then maybe if you just took a quick second to just think, oh, momentum is down today, it's okay that my stock is down, and I can buy a little bit. But if momentum is up, SPYs are up, the market's up, and the stock that you're looking at is down for some reason, then I would sort of take a look to see why it's down. If it's a downgrade, okay, maybe I don't want to buy it at 930 because there's probably going to be a lot of people that are selling it, and you might get another dollar move lower. So again, it's all context, right? We're hoping not to buy into any event. We're hoping not to buy. The event that we're looking for is really an 8-week trend. So in that first 20 minutes, you want to make sure that you're not getting caught up into this random movement up and down because some day traders, there's a tweet or there's this or there's that. It's not necessarily what the game we're playing. That's not to say that, UOA can't be used for the faster game. It absolutely can. And people do use it. They see something trading right now. They jump into piggyback it right now, and they try to play for the next 24, 48 hours. It's just, that's a very fast game. What we're looking at is a game that's not going to be as fast. Okay. It's not going to be as fast. We're trying to catch that longer time frame, if that makes sense.
Okay.
Yeah. And then as far as exits go, same thing. It's sort of picking that spot and building out that plan and saying, I'm trying to make 200 or 250% on average, which means if I sell my first at 100%, then I got to make some of that up. I have to be able to allow these things to run. Now, after 100%, which I like taking because it just eases the mind a little bit because it becomes hard to lose on that position. But not everybody does it. Some people say, I don't like the 100. I'd rather go at 150. And so that's everyone's prerogative. But you see that when we hit, some of these things run huge, and we're trying to allow it to run. We're trying to, if you're nervous because you've lost 3 times in a row and you've lost 50% or 60% on 3 in a row, and you're nervous to like sort of get that money back, that's sort of the emotions getting at you. And it's not the way you should be thinking about it, because in order to win at this game, you're going to have to let these things run. You're going to have to be comfortable letting it go up to 150, 200%, come off to 150, back to 125%, and then take off again. You're going to have to get comfortable with some of that P&L swing as it's a winner, because the ones that win tend to find that, it's sort of like when you're in a race, and once you find that speed and you start kicking that stride, it's like home free, unless there's a red light or something stops or something, a deer comes through in front of you and you got to stop to pick up that momentum again. It takes a lot of chugging. So same thing. It's once you start going, these things tend to start running, and you want to allow it. The hardest thing for most people is to, especially in the beginning, is to sort of allow these things to run. It's okay. And usually, I'm going to tell you this, usually that means that maybe the position is too big. Maybe the game is too big. And if the game is too big, that's why your emotions are getting at you too, because there's too much at stake. And you're up and down $100 every minute, and you don't like that feeling on one stock. And so that's sort of what you're fighting against, and what you're trying to options are a leverage game. So even with a small amount of money, it starts acting like a much bigger stock game, if you will.
Okay, cool. And
all right.
A question I was also thinking about, and now Tony asked it in the chat, is he can be watching market at the open. He's saying, should he be using limit orders or some type of automatic?
Sure.
trade?
So limit orders work a lot better than the market orders. I would just be careful. When I give the market closes 90 cents at $1, and I give $1. I'm not going to say, well, I want to buy this at 80 cents. It may never hit 80 cents. So I just want to be able to say, look, the guy we're chasing, I see a guy, he's paying $1. He paid $1.20 last week. He paid 80 cents. He paid up to $1.30. He's somewhere around $1. Okay. It closed 90 cents $1. Do I know where it's going to open tomorrow morning? I have no idea. Okay. But I'm trying to give you the full picture of what this guy's doing, how long he's buying. It is hard for some people to say, well, I work, and at 9:30 I can't be watching, so I put a market order. I simply would say that if you put a market order for $1 and the market is down the next day, and as you've seen in the last month, the biggest moves in the market have been basically overnight. So the market is down, say 1%, and now this stock is down 1%, and that dollar should be about 85 cents because that thing is down. So it should be about 85 cents. But you get a couple of people that are bidding $1 on the market open, and the market makers are not going to move it down to 85 cents. They're going to basically say, oh, this buyer's market open, they're willing to pay $1 or have $1 limit, then that's the price you're going to get. And then immediately within 3 minutes, it's going to trade at 85 cents, at 75 cents. And then all of a sudden you're like, I just paid $1 and I'm already thinking, when am I going to get stopped out? And it's only 15 minutes into the day. We're trying to avoid that. We're trying to avoid that as best we can. So the only thing I would say is that, the longer the term of the option, 4 months, 3 months, the more time you will have to actually look at it and allow it to trade a little bit. And I don't know what's happening the next day. I have zero idea. I have zero idea what's happening in the next 48 hours, 72 hours. But I do know that this sort of option is providing some great risk reward here, that if we're right here and the market either tends up and this stock moves here or the announcement goes its way, then it's good. So there is no clear-cut answer. So I can't say, well, limits are always great. Limits are good in the fact that they save you from being ripped off when the stock's going up. However, it doesn't save you at 9:30 when you say limit to buy $1 and the market's supposed to open up at 85. They're going to give you the dollar fill. And right off the bat, you're going to get the dollar fill, and 85 might really become quickly 75 because the stock keeps going down a little bit. And then all of a sudden it doesn't look so good. And so these are the types of things that I try to stress to people that, the longer the time frame of the option, the greater the ability you'll have to get in. The probabilities of it trading lower than my price is probably 90-something%. Okay, 95%. Now, the couple of times where it does and you miss it, people always remember that. They always remember the one, I missed that one and it went up 1,000%. What I like to say is, first of all, you probably wouldn't have never stayed in there for 1,000%. That's my first thing. So don't think about that you missed 1,000%. Okay, you probably missed one that was 150, 200%, because that's probably where you would have averaged out. Okay, so that's how you have to think about it, first of all. Second, you have to remember that, it's called, again, confirmation bias. Remembers the one that you missed, and it's so painful. But you forget about the times where you were a little bit patient, $3 option turned into, $2 options. And I spend a lot of time in the coaching trying to have people gain some patience and perspective and have them feel great about getting a better price, right? Having them feel, you waited 2 days, you waited 3 days, you bought one and then you just waited and look what you did. You were able to get here, or you didn't like the stock, or you saw that momentum stocks were getting hit. These are the types of things that they make a significant difference. So there's one thing about being option smart. Then the next stage in succeeding at this game is really, becoming a little bit of trader smart, a little bit of trader sense smart, looking at graphs, looking at all the different things that potentially may move the stock. listening to me talk about, what might move, relative strength. If the market's up, every stock should generally be up. If the market's down, every stock should be down. If the market's down, you're trying to buy calls, the market's down, don't bid it up. You're the only one. You're one of 10 people that are bidding up, and the market makers are surprised to see you, but they're not going to be hesitant to say, we're not going to take your money. They're going to basically say, you want to pay up? Fine, I'll sell it to you. And thank you very much, because now this thing goes from $1 to 75, 80 cents. So again, it's context matters. You can't say every, limit orders always work. They're good. They prevent the ability for the market maker to say market order. They're literally, they can do whatever they want when you give them a market order on the open. And sometimes you might get a fill $1 higher. $3, you spend $4. You're like, what happened? The next price is 3 1/4, 3, 280. So I think that the jumping of the gun at 9:30, 9:32 is tough. I also think between 9:30 and 10 o'clock, the big boys are generally not there. That's why the stocks move around so much between 9:30, 10 o'clock. When the big boys get in and they're going to do what they want to do, you see that the volatility of the stock generally tends to calm down, generally. Okay, in the morning, it's opens up, trades down, opens up, trade. That's because the market makers are moving it around, probably taking people out on stops, probably, executing market orders. They see news, positive news. They remember what we talked about in the Robinhood thing. They open everything up. Not only did they open the options up big, higher volatility, they open that up big, and the stock trades up on lower volume, and they're basically able to sell people stock because they're reaching, and also buying options because they're reaching. So you see a lot of that, and what goes into what we're talking about today. The market makers are probably having a field day on all the Robinhood traders by playing this game in the morning, where they know these people are coming in. Generally, maybe they're selling, maybe they're buying, but it looks to me like most people are buying these options, because I see the volatility jumps in the morning are very high. So they're moving that, they're turning that dial up, they're raising it up. You want to buy it at 200 vol, 210 vol, be my guest. As soon as you're done, we're going to start taking it back down 20, 30 vol clicks. Now on these types of names, it might be 20 vols, might be only 20 cents, 25 cents. Because they're such short dated, but it's still 20, 25 cents on something that you're trying to make, you need significant moves. So again, it's context. There's not going to be any clear answer that this always works or this doesn't work. It's about understanding that you might miss one, but in the long run, 95% of the time, the price that I'm putting there is not going to be the highest price. And a lot of times, if you think about it, if you can be patient and you can actually say, oh, okay, I'm getting it down 20, 30%, you know what, I'll take a shot there. Or some people, they're looking at it and they say, okay, that call option was $1. The market opened down. Instead of that strike, I just bought the strike below. That's also good. That's not a bad thing. You don't have to pick the exact one I picked. I'm picking that one because that's sort of the one that we saw the buyer buy. But in hindsight, if we get a chance to buy the lower strike at a better price, that's even, I'd say that sometimes that's even better. There's never, I try to refrain. My role is to spot good risk reward trades. I try to refrain from being exact with people, because I get out of a position and then the thing runs 1,000%. People are going to be angry. You stay in a position and it goes to 400% down to 200. People are going to be angry. Everyone is going to be angry on. You cannot please everyone. So the only thing that I'm saying is we're spotting these trades, like I'm trying to spot them here. When I'm giving these trades out for overnight into the morning, it's because I see something that has the potential to be up significantly, and you can identify sort of, this identifies, it checks all the boxes. We're honing in on something here, and we got to let it play out, and that's what we're doing. So again, I'm not here to tell you that there's any right answer, and anybody who tells you there's a right answer is probably not telling the truth. It's about finding the best answer that fits you, and ultimately that starts with how will you feel if you miss it? How will you feel if you get it and then get stopped out early and then it goes up? It's trying to figure out who you are as a person, and how much of this, what we can call FOMO, you have the fear of missing out. I have a lot of fear of missing out. just me as a person. I'm a passionate guy. I think I'm right about every trade. I have a massive fear of missing out. It doesn't do well for me. So it's a constant battle for me to like tie my hands to the chair and maybe go get some, breakfast or another drink or do something to stop myself from looking at it at a certain moment. So you got to know who you are, and everybody is different. There's some people that are able to, again, same thing with exits. They're able to take, I see people, they email me, thank you so much. I made, I made 700% on this trade. And I'm thinking, wow, like that's impressive. That's impressive. I made 1,000%. The first time I've ever made 1,000%. And in my mind, I'm thinking, you rode that trade all the way to the end, all the way to the top. You got 1,000, you take it off, and it was that easy. That's hard to do. That's hard to do. Not everyone can do that. And but there are some people that have that, that ability to just do that and say, most of the time, because I've asked some of those people, most of the time they're playing it a little bit smaller. So they don't have all their chips in one stock. They have one chip, out of many, a pile. They have a couple of chips here, and it's okay to let something run because it's meaningless to their whole stack. But as a piece, it's good, and you let that one run. That's how it's supposed to be played. But still, it's very difficult to watch something go from 0 to 1,000, never take anything off, and that's how you play the game. That's like a robot. A robot can do that.
Right. And I'm also sure there's a lot of people who take it off too early and then hurt themselves like that over time.
Of course. You or it goes up to 70%. You're like, you know what? I'll take this off, and and we'll keep playing to the next one. Everyone finds different ways to play it. I know someone who just waits for 50% up and just gets out and has looked at it and says, your track record is pretty good, that at some point in the life of the contract, it's going to hit 50% and you get out. That works until you miss 4 in a row. And, now they're using stops too, but it's sort of a flip of a coin type of thing. But they're looking at it and they're saying, as a flip of a coin, you've been pretty good, that I know over time I can do that. So everyone finds a different way to sort of play their strategy and play their plan. Some people don't like writing things too much. Some people don't like stop losses at 50, 60%. So everyone finds, I'm always getting asked these questions. Some people say, well, if I play a smaller game per chip, per trade, why not just buy it and then let it go? Because over time, if I look at the stats, I could just let it go and say, I'm going to wait to 800%. And if it happens, it happens. If not, maybe it ends up and I'll get out before earnings. To be honest, that has worked, and it has worked very, very well over the last 18 months. However, there's a story within the story. If you looked at it, how it has worked, and I'm telling you very well. Just letting it go, buy it and not doing anything. No stops. Don't worry about it. If it gets to X number, just get it out. Take it off. The interest story is, the ones that go to 600% and then go to 0, and then you're looking at that one. Can you handle that? Like you're that's the game you're playing, and that will happen. How will you handle that? Do you care about that? If you don't, some people say, it's one chip out of many different things, because that one was good, but this one I would have gotten out at 200%. So I'm just gonna let this one went up 1,000%, 2,000%. I hear you. It's just, can you withstand that pressure? Can you withstand sort of watching something go up every single day without taking anything off? It's up to the individual. That's what makes this game absolutely unique to everyone. There's not going to be any one, look, there are people that you can go follow. Go take anyone. Go try to follow somebody else's trades. It's almost impossible, because the person might be getting in and out too much, too fast, that it becomes very, very difficult to follow someone. So, trading is something that is very unique to people, very unique to their emotions, their emotional state, how they think about it, their plan. I'm at OptionsGeek, my goal is to make sure people understand the elements and understand best practice, and then find that groove that best fits themselves. There's no right answer for any one of these. Like, what's the exact time I should get in? What price should I get in? How exactly? The best practice I can give you is not going to fit every mold, and it's surely not going to fit the psychology of every person.
Okay.
Cool.
Great.
Awesome.
Yeah, that was great.
Awesome.
It's a psychology game, right? So,
It is mainly when we're learning the nuances, but ultimately at the end, it's how much of that psychology can you sort of help manage
mhm.
and try not to let it eat at you or get you. You know, you take 3 losses in a row. How do you feel? You know, all of a sudden you start getting nervous about the fourth. And it's, again, it might mean that you're trading too big. Usually the answer is you're trading too big.
Mm.
Usually I've seen it a million times, myself, everyone, sitting next to guys at work on Wall Street where big means hundreds of millions of dollars position. It's too big. Some people saying, "Oh, my back hurts." My friend of mine, every time his positions are too big, his neck or his back starts hurting, and like his size of big is billions of dollars. You know, your body. George Soros used to say in his book, he says, when I had a position that I was unsure of, his lower back would hurt. So it's stress, right? It's stress, emotions. What's causing the body to react a certain way, or causing you to feel maybe anxiety in the chest, or causing you to look at your phone 300 times per day because you're nervous about every one thing. The answer, like I said, in all instances, or in many instances, not all, in a lot of these where the pain, it's always, hey, maybe you're too big, and it's okay to just take off half. If this one, you can't stop looking at this, just take off half. And then, you'll see how much you relax. And remember, how you feel about one trade, we're humans, does affect how you feel on the next trade and how you get on the next trade. And so we're trying to always minimize that. So whenever you feel something is too big, or you just reduce it. Someone says, what should I do? What should I do? I said, it's always okay to just take half, or just, take it off and move on to the next one and keep going. But again, that's a learned skill to be able to do that, to be able to sense that I'm feeling nervous about this, and I just want to step aside for a second and watch. I don't want to be in this trade anymore because it's making me look at it 400 times a day.
Right.
Okay.
Yeah, it makes a lot of sense.
All right. Good.
And
Good.
okay, so before we jump into looking at some UA, I want to highlight Dean's comment. He said, "Thanks for the overview of Macy's last week." He said he's been
Good.
options. Well, it's cool. Yeah, I actually played a little bit of M.
Oh, good.
And I got
Good.
out today. It was
good. The retailers are up. You see, so
yes.
So let's start there. I mean, that's good. So the Macy's, you got JWM, you got you got KSS. The retailers are good. So anecdotally, the in New York, the malls were packed. Last week.
Okay.
I mean, you couldn't move, and I think what happened is that we were having trouble. UPS wasn't coming with the gifts. Santa Claus wasn't making it, and, I think people started panicking. And so if you wanted to go, to the mall, the malls, there was lines to get into every store, like 50 people online just to walk in the store, because like I said, Santa Claus is not there. And we sort of need some sort of, some sort of gift for our kids, whatever. People were spending a lot of money. And so maybe the retailers were down so much because over the course of the previous month, we heard about how online shopping, everybody was just going to do online shopping. And they were, until UPS and FedEx can't deliver. And then all of a sudden it's like, oh my gosh, like I'll go stand on an hour line. And then when I get in there, I'm not going to stand. So what happens? I'm going to stand on the hour line. And then when I get in there, I'm not going to go spend another hour on that line or in that line. So you spend an hour, you spend an hour to get into Macy's, and you buy everything in Macy's, or you buy everything in these, so that's the mentality. And I think that, look, the stocks are up today and they're trading well. Macy's trading well. It traded well 2 days, on last week on Wednesday as well. And, maybe that was a little bit of clue that Christmas was shaping up maybe to be a little bit better. Remember what we said, these companies, coronavirus may have been terrible for society and humans, and human psyche, but for businesses, they got leaner, stronger, tougher. And unfortunately, that means that they laid off a lot of people. So I was reading an article about how Macy's and Kohl's stores, these people, they hire a lot during the holidays. And this year, it was, I think the numbers were probably about 10 to 15% of what they generally hire. So you can imagine the amount of people, the amount of money they were saving on not hiring as many people. Again, getting leaner, stronger, thinking about margins more, thinking about people, the jobs on retail. People are being hired to work in warehouses. Sounds like Amazon, right? That's the whole, new model. So that was a good call on Macy's. I still think it looks good. I'm looking at let's just take a look at it, because I saw it earlier, and I just thought stock's trading well. It's got to be that people are. Let's see here, January 15. I saw the. Let's see. The January 12s. January 12th. How about February? The volatility is down here a little bit, so maybe people are taking profits. You see that? It was actually up before, so maybe people are just taking profits. That says, the stock may have hit this wall. You see this $12 wall here,
right?
So maybe people are sort of getting rid of some of their calls. But I did see some call buying in January. A lot of people still playing this December, and you were talking about December, right?
Yes.
And so those Decembers worked out nicely, and it's it probably was that Christmas, and
Right.
these stores were doing okay.
I got in on the December 11th. December 11th strike calls.
Yes,
40 cents, and I got $1, so it was
nice.
It was a pretty good one. Yeah.
So here's the 11 and a half. It's actually almost 12 here. 11 and a half of trading, and devolves up. So it looks interesting. It looks interesting because if it breaks 12, I tend to look at this chart. If it breaks 12, this is, let's just go back a little bit just to get perspective.
Okay.
We talked about it the last time, but it breaks 12. This is a big level right here. Okay. I'm just eyeballing it, right? What are the big levels? Clearly 36, top, and then over here, there's a low. It did a little dance around here. The low is here, 13. So 13 to 15. And this was a low, and this is a high right here. So 18, 13, 15, 18, this area right here. This dropped through, and then this was a level, 10 and a half, call it. See, there's a gap here, 10. So, the way I tend to look at these things is longer term. I want to find, something that I can chew on and say, yeah, this looks like, I call them pivot points. And I try to use as the least amount of lines as possible to try to just gauge sort of where the money flows were. People were long Macy's for a while. There's been this story for going years about how they were transforming the stock. And then when it dropped here on coronavirus, you could see the volume here. And this volume means that all these people that were long for all this time and waiting, and actually, there's probably some selling here. There was capitulation right around here. The stock traded under 5. Never good for these big companies to hold stocks under 5. They just don't like doing it. So stock comes under 5. You see the volume. We're talking about 250 million shares trading. Over here, we're talking about 350 million shares. This is everybody getting out. If you are getting, we're in this for the last 4 years, you're all getting out. That's why volume is important. Volume is telling you that story that as this is moving down and gapping down from 16 to 6, there's a lot of people getting out. Now, that means there's a lot of new people getting in, or people that were in it for a while, just doubling down or tripling down or whatever. But there's a lot of, if you were holding Macy's, it's highly likely from 35 to 5, you are getting out. So what does that mean? The sellers were getting out, which means the only thing left right around here is a lot of long-term holders. There's maybe 75 to 80% are now they're in it for the long run. And it's a waiting game, and they waited here, and, more volume is picking up here. And now it's reestablished this. Remember, everyone below 10, anybody who sold here is now not feeling so good, because now it's trading 10 and it's looking higher. So I'm not like, I don't know enough about Macy's, and it does seem to have some problems with the big general trend. But this stock right now is looking bullish. It's looking like any good news coming out of earnings, because the Christmas was a little bit better than the worst possible outcome. You could get something that gets it to like $15, $16, $17, $18. Right? This is sort of this right here is where I'd be looking at, for movement. And so when you're seeing people buy, you go back and say, all right, let's look at Macy's, in February options. If I want to buy the 12 calls, and people seem to be long them here and long some 15s, you're looking at target stock prices of 15 to 18 bucks. You see 14.77. So if you're buying any one of these, if these were actual buyers, then that's where they're looking at. Right. And I think where that jives where that jives well with is the chart, right? We're seeing, can it go to that level? Well, if somebody's getting these reports and getting data that, you know what, these last 2 weeks were tremendous for these big retailers, then and they're going to report a good earnings, then, you know, the next earnings is not announced yet, but I'm sure somewhere you can probably get it over here. And they're going to be looking at these types of calls. Because if you look at cold stores or you look at JWM, look at JWM and how fast. How do we do this? Let's see here.
Click in the middle of the mouse.
Yeah, let me just do it again.
Yeah.
So you look at let's look at JWN, and you can see how fast these things move when it's not as bad as you think, right? We were looking, we had calls here thinking this was going to happen. The thought was we're following guys that are buying. There were big buyers of calls right around here. Right around here. I mean, big buyers. They're massive buyers. I was talking to guys thinking that this thing could rocket. And we were long calls. You know, we long calls. And you know what? It went down first, which was a disaster. And then it shoots up. And it's like, you know what? It took a little bit extra time. It took a couple of more months. But this is what happened. And stock goes from 12 to 32, looking like it wants to go back to 41, right? So we're always in these positions that have the potential, and that's why they're buying calls. That's why people are buying calls. Do they always work? No, but when we're spotting them, you know, there's a story behind the idea of how these things can move. So I like Macy's. I think Macy's right now is actually bullish. I'd be more worried if somebody came in to buy Macy's 10,000 options, 20,000 options. I'd be worried to sell them because this can get to 16, 17 in a hurry. And, you know, we've talked about in the Robinhood and the
one that's coming up.
We're going to show you how from my angle sitting at the bank, how I probably may not be happy to sell $12.50 calls for $1 if this thing's going to shoot up and rocket to 17. Okay. So we talked through that and we walked through that. So that's Macy's. Let's go to the next one.
Cool.
What else are we seeing? I see a couple of trends here that, you know, I would throw one at you, which is, you know, decent news. Baba, you know, is something that's been in the news. Jack Ma really screws up, forgets where he made his money, and basically ridicules the Chinese government, including the premier, the prime minister. And I mean, you know, what do you say? The guy's, you know, missing now. I mean, he got put in a corner like a kid and saying, like, go sit over there. And his Ant Group, which was going to be the biggest IPO ever, comes down. You know, I think what's interesting is, you know, Baba's doing everything by trying to buy back stock. They made an announcement today that can't lift the stock, although the stock was down a bit overnight in China and here. But, you know, at the end of the day, you know, the Ant Group was told, which is interesting. The Ant Group was told, we don't want you to do lending. We don't want you to do wealth management or these insurance products, all these products where they make their most money. But you know what, Jack Ma, you can go stick to payments. That's a great place where you should be. Stick to payments. Well, it turns out that payments was of this Ant Group. Payments is the gateway to all their other products. So payments, they were actually losing money in payments, right? It's like Amazon is doing razor thin margins in the market, in their, you know, in their retail business. They do razor thin margins in order to get the customer in the door, to get the customer to buy all these other different things, and to get data from them so that they can resell the data and understand who the customer is, and then go buy Whole Foods for a cheap price and then make a fortune. So that's, you know, every one of these large companies has this loss leader. For Baba, it's payments. And it's just interesting that the government said, go stick to payments, everything else, you know, tone it down and, you know, go sit in a corner for a month. And I don't think anybody's seen him for 4 weeks. So, you know, it just goes to show you how you don't, you know, the Chinese government, when there's a monopoly in their country, how they deal with it. I mean, it's 6 weeks since he made a comment, 7 weeks. And Baba went from, you know, going to do this anti-IPO and it's going to raise billions of dollars. And Jack Ma was going to become maybe the richest guy in the world. And now nobody even knows where he is. And the government just says, nah, you know, we're done with Baba. We're done with that. Much different. It reminds me of what's going on here. Much different in here, where you have these large tech names, and then you have a guy like, I call him Mr. Facebook because I can't pronounce his name. It's like Chamath Palihapitiya, something. I'll just call him Chamath. I'll call him Mr. Facebook. Mr. Facebook says, you know, I've made a lot of money, who knows, $1 billion. And now, you know, it's Silicon Valley versus Silicon Valley fintech versus the investment banks, where this guy says, I'm going to do 26 SPACs. And SPAC is simply, basically, it's a shell company or some company that they say, hey, this is a company, this business is terrible, we're going to like blow this out, we're going to raise money, and people are going to give Mr. Facebook money because obviously he's good and he's Mr. Facebook and he's done it before. And so we're going to give him money and we're going to enter in these SPACs. And Mr. Facebook, with all his connections in Silicon Valley, and he has a lot of, he's not only going to put a good CEO on each of these A, B, C, D, all the way to Z SPACs, this company, which is just money. Okay, you're just giving a guy money, and he's going to then take that money and say, okay, we want to, where's my friend, what's his name from space, Virgin Galactic? What's this? Richard Branson.
Right.
Oh, yeah, let me call Richard Branson and say, hey, I can take you public. You don't have to go through the investment banks. And the investment banks, they charge a lot. There's regulatory process that you have to go through to do an IPO. There's a lot going on in an IPO. And it takes months and months and months and months and months to get it all, tell the story out there. Well, you have these IPO SPACs, these SPACs come that are basically IPO in stocks, and the story's good, right? It's like if Clover was going to go IPO or Space was going to IPO through Goldman Sachs, how many shares were you going to get to the little guy? How about you, Robinhood players? How many shares were you going to get from Goldman Sachs? The answer is 0. Okay, especially if it was a hot deal. If it was a bad deal, you'd get as many as you want. But if it's a hot deal, which is one that everybody wants, nobody gets, right? So what he's saying is, we're just going to do this SPAC. They found this, I don't want to say loophole, but basically it's a way to take these companies, buy a chunk, and then change the SPAC name from IPO A, IPO B, IPO C, A through Z, to IPO A becomes Space, SPCE, which is Virgin Galactic. IPO B becomes Open Door, which is a competitor to Zillow. IPO C is Clover Health, which is going to take over, healthcare. So, these are all stories. Each one of them will be a story. Whether they pan out, I don't know. But they're disrupting this fintech business. Who's not happy? It can't be that Goldman Sachs, or Morgan Stanley, all these people are happy. The banks are happy, and so. The way things work in the United States is lobbyist groups get paid a lot of money to go tell the senators, you got to change that law. You got to make it harder. We can't make money. We're Goldman Sachs, we can't make money because we make a lot of money on these IPOs and the mergers and acquisitions and the banking. And if we got fintech beating us to this, then, we can't do it. We can't compete. We can't, obviously it hurts us, our industry. So this is where the lobbyists come in and they start forming laws, and this is how laws get formed. But there is a fight in the United States between fintech and the banking system. Unlike China, our government doesn't just say, hey, Mr. Facebook, Chamath, whatever your name is, you can't do this. Go back to, playing the billionaire games with the Facebook guys and skiing or whatever. But right now you're hurting the industry. You're embarrassing the investment banks. It's not going to happen. So I think it's an incredible time in this, I call it IPO history, where you're able to get some of the sexier names come through these SPACs and people are buying them. They're getting involved, and you see them pop up as IPO A, B, C. I think there's another one just announced, D, but they're starting to buy them, and they're starting to buy them in the anticipation that they're going to do something with the money. Nobody knows what they're going to do, but they're going to announce they're going to do something. And you can see that they just hired, I was looking at, let's see if I can find see if I find it later. I'll send it to you. Each one, they've announced managers, and you see these are high profile CEOs. They say the CEO of IPO D, the CEO, and each has one of them was the ex-CEO of Twitter. So I wonder what he's going to buy. I wonder what he's going after. Who knows, right? Ex-CEO of Twitter knows that social media game inside and out. Maybe there's a social media there that they want to buy piece and sort of IPO into a stock. Who knows? Maybe, I don't know, just like a stock twits or something. Like, he knows that game. Not that the guy Howard Lindzen would want to sell it. I have no idea. But he's a guy, social media. He knows the game inside and out. Maybe he wants to do something there. Mm-hmm. So I think they're very interesting. Until they're not, right? Until they're not. So the SPACs are, again, another trend. This year has been the year of the SPAC, the year of EV, the year of these growth names. we'll see what happens. But let's take a look at one name. We see the BABA. The BABA is interesting just because they're coming after this, but it looks like, you're looking at 100,000 options, 66,000 options. They're coming after these things, but it looks like they're selling. See how the vols are all coming off? That means vols coming off, they're being deflated. So while you're seeing a lot of activity seems to be on the sell side. They're either getting out of positions, stock has been down, maybe it stops going down at this level. So maybe people are selling out of their puts. Okay. And maybe, as they're buying it now and they're buying the stock down here, but then they could sell some 230 calls as a strategy. So buying stock, maybe selling the calls, or just simply, the stock has lost its mojo. And so they're just selling calls out that they were long, trying to take a shot last week. So that's what I see here. But I see that the board is coming in. So that's not something that in general that we'd want to sort of be taking a big look here. What else?
What else? Apple, you want to talk about?
Yeah, go ahead. What do you see there? Stock's incredible.
Right, stock's incredible. And so this is kind of my theory that I've had watching of all the companies, Samsung actually. So I've seen Apple on the chain, and for the last couple of days, I've seen that they announced Samsung had announced their new phone line. So S21, that's the family. And here's the thing with it, right? So for the longest time, Apple never had SD cards, which are, you buy, you have more storage, right? You just put in the phone. Samsung had it. All the fans of Samsung loved it,
Right.
Now with this model, they're actually getting rid of it. So that's one thing. Second thing, Apple got rid of chargers and, headphones that you get with the phones. Samsung was mocking them for it. Now they're doing it as well. So that's another thing. People are really, really mad about these different things. Last thing is they actually downgraded the screen resolution on the S21 models, S21 and S21 Plus, right? And it's going to have weaker, let's call it like that, than the last 4 generations. So that's a big, big bummer. And the fact that Samsung actually manufactures iPhone's screens, supplies it to Apple, it's really weird that they made this move. So I'm thinking, these guys, they're just shooting themselves in the foot. And people are thinking, like, why would I buy this new phone? I can keep my current phone, or I can switch to Apple. Apple is, sexier, it's cool, it's hip, people like it. And especially internationally, people are really looking up to, Apple. It's usually more expensive, but now these S21s are as expensive as iPhone. So why wouldn't I go with an iPhone? My significant other, she also said, I've used a Samsung phone for many years, and now that you told me all these things, why would I upgrade, right? I'm just going to go ahead and buy an iPhone. So my thing is, if they get all these people that are dissatisfied with Samsungs, if they can get them into buying an iPhone, getting them into that iOS.
Right. You only switch once. So if you're going to switch, it's for the long term. And so maybe Samsung has misstep here and they get market share. So I would say I like it. Did you see any specific calls that you're looking at? I see a couple of things.
Right. So when looking at it, I was thinking this. First things first is that I was looking at the announcement dates. So this S21 model is going to be released on January 14th. It's going to go on sale January 29th. And I'm thinking if they don't make a lot of sales, that could be a good opportunity for Apple to,
why don't we talk about which options do you see? So I get the story. Which one do you actually see?
I think I was looking at February 19th.
Okay.
And because that makes sense for me, given release dates.
No, I understand, but I'm not asking for Marco's idea. I'm asking, remember what we want to do, and nobody wants to know Felix's idea either, so don't be offended. But what we're trying to do is we're trying to find the option first, and then back out the idea. So it's okay that you have the idea. I like that, and I actually like the story. Although I have a comment on the story, I like the story, but I want to know. I want you to first find the option, then go find the idea. Okay. Right. So let's look. I do see a couple of things. I'm just not sure. Apple is one of those names. So here's unless it's so clear where everybody's buying calls or buying puts or whatever they're doing, it's hard because there's a million options trading in Apple. So for everyone that you see buying, there's somebody selling. On occasion, you do see the change in the implied vol go up across the board. So that's good. The one thing I would say about the idea is that it focuses on Samsung, and there may be a misstep. And I would say that Samsung is worth, I think it's worth $500 billion, so 500 billion. Big company, but they do more than phones. And even if Apple took over their whole phones, it's $250 billion. So Apple is, I don't even know now, it's 2.5 trillion. I don't even know. It goes up every day. What's Apple? I was looking at Bitcoin before too. Apple stock. Let's take a look. Apple stock is 2.31 trillion. So say Samsung's phone business is $300 billion. If they took all of Apple's phone business, then the stock would be up 10%, right? So what's happening here to me is they're saying something about Apple that is a lot more than just a phone, although that's big because to some extent that might be Apple's lost leader. And so what you're saying is that what we're thinking is that maybe 300 billion in Samsung business might be worth $1 trillion to Apple, which could be the case. You could be dead right about that. It will take a little bit of time, but maybe that's part of the story. But the other part of the story is that this car thing is people starting to make sense of it and saying, if Apple is the solution for cars, then General Motors, Ford, they're all going to be building cars still, but they're going to be buying Apple's engine, if you will, a solution, battery, and software. And so that is a very, very, very big. If it's not an Apple car, then it's just a solution. Then it's the software. It's a very, very big thing. So I think what you're saying is really interesting. Maybe just for more positiveness coming out. If I look at the stock here, this has been a tremendous run. Now they're looking, this is reaching, let's just call it another high here, 137. I mean, this is a big moment in Apple. The stock looks extremely bullish. The MACD is just still pointing higher in a way that it is. So I think, yeah, I mean, what you're saying is adding on to the car news, the general momentum upside. Yeah. So, and the only thing I'm concerned is to move Apple 10% is, not that it hasn't moved 10% in a week, but to move Apple another 10% would be $230 billion. 10% move in Apple is a lot. It can't just be that they got some good earbuds. To move Apple now, it's more of a bigger, are they going to take over the world in healthcare? Are they going to take over the world in cars? These are the earbuds, no matter how many they sell, it's like, it's nothing to Apple, right? But they conquer healthcare and insurance and software back in, you're talking about $10 trillion. They tackle cars again, $10 trillion. So, I think those stories are going to be what takes it up or down. And, we talked about the AI and, how Apple, the more users out, it could be a loss leader. So the more users Apple's has with the phone is every person's map now on a daily basis, right? You do whatever it is off your phone. This is so let's go back for a second. If Samsung's business is $250 billion and Apple takes their whole business, for Apple, it doesn't mean that it's 250 billion. It might be $1 trillion because each person that they're taking has a longer term value than Samsung, right? So maybe that's the story. Maybe that's something that you're onto. And it just leads to more of the Tesla. And if they have the car and everybody has a car, has a phone, if you have the phone, it's an ecosystem. So it's like a monopoly, if you will. A loss leader might be the phone, where they're not making as much in phones anymore. And everybody thought that was the end of Apple 4 years ago. And all of a sudden, the software, the apps, and the amount they're making on software services is blowing up. And that's the big story. So I think you're onto something. I think, yes, but the problem is, does it happen like right now? It just seems like, wow, to get to, let's see what they're buying here. If they're buying these, most of the time you have a lot of holders that have been in this forever,
Mm-hmm.
and they're more likely to, in my opinion, they're more likely to sell the 145 calls, take in almost $5. The stock would be have to be up another 7% in 8 weeks, but you get through earnings. So maybe they don't want to do that. So maybe they sell like the Jan 15. Usually these guys don't like to sell too much above, the earnings, because it could explode. But if you look at the January, or they'll sell it right, before the event happens. The January 139, 140 calls. So you could sell that. There's only 12 more days left in this, and you could sell the 140 calls at $2.60, say 250. 250 is almost 2% of Apple stock, right? So if someone has been long this stock for 10 years, 5 years, 4 years, they already have long-term gains, they could sell these calls, not on 100% of the position, just in case it rips. And it does look like it's trying to break this to go another $10 higher. So I hear what you're saying, but they might sell a little bit just to collect a little bit of what they call a dividend. Again, it's 10 more days left, right? So that's a lot for 10 days, 2% in Apple.
Mm-hmm. Mm-hmm.
Okay, so that's how I would think about it. I think that your story is good. I think that you have to look to see. I want you to look, in order to make this valuable for yourself. I want you to look at the open interest at the unusual options chain, and then I want you to go backwards to find the stories, and then, which is what we're doing, I want you to log those stories in your head, so that even if you don't play it, then you can come back to it. So something like Macy's, like if Macy's, you played it, which was good. If it comes back in, you still know the story and you still understand what's going on and what it is. That's how I would look at it. Like GME, we have a good story. You see this one today?
Right.
GME, the GME story was, basically January 17, and today he looks like he's selling out of the January 17th, and then look, he's coming in to buy 8,000 of the 21. So he's just rolling to February. And if you stick in where we thought, he still thinks 13. He still looks like he still thinks $13, but he thinks that he might need a little bit more time than January.
Mm-hmm.
You see that?
Yep.
So that's how we're getting into what he's thinking, how we're backing it out. 17th, he's still, he's not thinking, that anymore. We thought we had him pegged at around 13, 14. And that's starting to tell him, hey, look, these aren't going to work anymore. The stock's trading 20 and a half with only 12 days left. You got to get out. You got to move. You got to start acting. Get out of this. So he's thinking to himself, I got to get out of this. 12 days left. I may not have a event here. Let me go out to February, and February is going to do something for him a little bit here. So looks like there we go, February. So that's how I would look at this and say, okay, he's trying to find that spot where he can grab an event and get to that 13 level. So the guy's still putting his money where his mouth is, trying to short the stock. Stock's up again today. So we'll see. That one's got to play out over time. Go ahead.
It's probably a lot of fluff right now, people being really hopeful and all, but we'll see. We'll see what happens.
Yeah, I'm not sure about that one. But what about this Zoom? What do you take on Zoom? We've talked about Zoom, and how about this FUBO down? Remember we talked about this one, that it was really so toppy. It's like, you look at, I personally believe, this is what I believe, that all of these momentum names, they end the same.
Mm-hmm.
Okay. The problem is, they all end the same. Talked about a lesson. They all end the same. Okay, here's a big move. So this looks like the mountain, and then you're climbing a mountain, and then it just drops. And now all these people, look at the volume stuck here, buying. Like this is the next, Netflix or whatever you want, Roku. Stock drops here. Shorts don't like, we talked about this lesson, but shorts don't generally try to get all in here. They understand this game. This is a rocket ship, and nobody wants to be in front of a rocket ship. So the shorts don't really like, they might buy a couple of puts here. They might buy, short a little bit of stock here. They're warming up. But what they're really waiting for is this massive move up. And then you see that move, how it ends on the low? So up, sometimes it goes up and then it ends on the low the same day, but this is up, next day up, and then ends on the low. This right around 55, 52, when it's breaks that open, that's showing weakness after this tremendous move. You're going to see the shorts start coming in here, and they're pushing and they're pressing and they're pressing and they're pressing, and they're going to press until the market says, "No, we like it here," wherever that is. They don't believe, they might be covering a little bit here, and you could see usually what happens. You see the stock try to make another last gasp to here. It's got to try to get back over 62.5. And then the shorts are going to cover again because that's no good. But they're going to be playing around here, and now it's this formation. Sometimes it happens 1 day, 2 days, but here's where the shorts get excited. It's extension 4 days. It ends at the high, which blasts every last. Anybody who's thinking about shorting, buying puts around here is now blasted, and they're going to come back. They're going to come back here and start getting. They're going to start pounding. The shorts are going to start pounding here until somebody says, "No, we like it. We this is the right level." They're going to keep on pounding it as best they can. What else? Let's look at something else that I saw. I would say let's go real quick. I mean, let's look at
what we see on the UAE board.
Yeah, what we see real quick. I mean, I haven't looked at it here since we talked, but Facebook up. There were some call buys in the last couple of weeks. So Facebook up today. The big names are all up. Apple, Amazon, Facebook, Microsoft, Disney. Just look at the big top 10, top 15 names in the S&P 500. It's incredible. They're all up. And you're starting to see a little bit of weakness on some of these other names like the FUBOs. Sporadically you'll start seeing this. Zoom is weak. Okay. You don't see too much. You don't see too much put buying in a lot of these big names, but you look around and you start seeing a lot more volume here on the puts. Out to January, but even February. This one was this caught my attention here, where you're starting to see people set up over here. Let's see, March. There's no open interest, and these puts are high, but where was it here? January 8th. I saw something here before January 8th. No, it's taking a little bit of time. January 31st. Computer's slow here. Okay, here. So this is this week options, and people are buying. It looks like they're trading a lot of these, the 350s. You see here right at the open, they took implied volatility up from 62 all the way up to 69. They bought these puts. They're buying these puts right out of the gate. The stock trades from 372 down. So they're buying these puts and the stock's trading down, but they made them pay. So they did pay 69 vol. You see how they did this in the morning?
Yep.
And now the vol is still up 7. It was 48 yesterday, and they made these people pay 69. And then look what they did. It's exactly what we talked about on the Robinhood. It's the vol is so high, and then now it just trickles back to normal. You see that?
Yep.
Now they're 1 week options. They're 1 week options, but they, so the volatility is not going to mean as much. What they call Vega. So 7 volatilities for just a 1 week option is different than 7 on a June option. So you keep that in mind. But essentially, it's just doing this dance in the open. Nobody knows where the market makers surely don't know where the stock is going. But someone comes in to buy puts, you're going to pay the price, and then it's going to come. I don't know. You could just take a look right now. So the stock is down from 371 to 360 to 357. They paid at 931. They were paying $2, $3, $4 for these puts. So they pay, say, an average $3, $4. And where are they right now? They're only 470. Look, see that? Did you notice that?
Yep.
They paid $3, $4 with the stock right around here. The stock is now $10 lower, and the options are only $1 higher. You see that?
Yep.
That's how they made a lot of money there. They probably made a good amount of money there. Right? So that's exactly what we were talking about, how nobody will realize how they actually lost money. But I'm showing you right there. They paid right there on average. You can go look at the average prices yourself and see where they paid, because you can actually do that, right? You could see from 9:30 in the morning. Just go back as an exercise, figure out where they bought these, where the stock was, okay, and then how the stock has changed and how much money they made. The stock is down from 371. The stock is down $16, and those puts only went from 220.22 to 4 and change right now on a $16 move. That's not. It's good, but you would think that it would. You catch a $16 move in ZM, a 5% move. You probably want to make in a 1 week option. You probably want to make a little bit more money. So that's part of that is because they force them to pay too much. So Zoom, the put buyers are coming in, which is interesting because coronavirus is supposed to be, still booming again and getting its second legs. I'm concerned that these names might be done. Like again, a stock like Zoom, was that the mountain? It's concerning. It doesn't look like the one that we see, but this was a long protracted move higher from 100 to 580. So at some point it's going to find some ground. Maybe it's 280 to 340 right around here, the gap. But that's something to look at that's something to look at and keep in mind. I would say, see how it's this gap right here from here to here?
Yes.
I would watch that. So, so that's what I see. I don't see a lot in the bigger names. I didn't before. I see a lot of the smaller names trading 1 week, 2 week options. It's a very, very difficult game to play. We could talk about, lastly, we'll end it off with the Riot, Mara, and there's another one that popped up, Clean Spark. Did you see this one?
Yeah. They're in the same Bitcoin business.
Yeah. I mean, this is CLSK. So that popped up. I think it popped up last week. I remember seeing this, but today it was, front month options, trading big, expensive. 30 calls are, not expensive. They cost a lot. $3 for the 30 call, but the stock's up 13%, but there's only 12 days left. So it's you got to catch that next big. And you could, if Bitcoin goes through 30,000, this thing will trade 35 tomorrow, but I don't know if that's going to happen.
Right. Okay.
Cool. And anything else, man?
Yeah, we got one question from, I think his name is Daniel. I'm not sure. If you go to the volume, if you click on one of those volume ones.
Yep.
And you're looking at bid ask.
Yes.
So those don't always add up to 100%. He wanted to know why.
Okay, good. So they don't always add up to 100% because the machine is trying to determine if it was actually on the bid or on the offer. So sometimes if the market is $1 to $1.20, let's just say, one bid at 120 and everything trades at 120, then that would be the ask. You would see 100% on the ask. If it trades at everything that trades at $1, you would see 100% on the bid. If it trades some at $1.02 or $1.05, the machine is smart enough to know that was likely towards the bid side. So I think it counts. There's some, I don't know the exact parameters, but they would count some of it on the bid. But if it trades at 110, then the machine, it's just data. So the machine doesn't know, probably anywhere between 107 and 112 or 107 and 113. The machine is going to say that was mid-market and we don't know whether it was on the bid or it was on the ask. So this is trying to capture what it can just by where it traded. But it's not always going to capture the mid-market ones, and you're not going to know if the machine's just not going to know. Okay. One thing to remind yourself is this is one of the ways that you could determine whether someone bought or sold. However, I want you to remember that just because it says 73% on the bid, it may not be that it was sold. It may be that you see the guy was buying 471, buying 474. He was chasing, buying 493. So 493, only 30, but it says 73% traded on the bid. It might be that he bid it and someone sold it to him. The market maker sold it to him. And then he bid, 102. But we don't know for sure. This is just a gauge. You can't say because this was 73%, I can't be 100% sure that these were sold, this 30 lot. Same over here. There's, 40, 45. This is a gauge, and because if you think about it, if someone's going to buy 20,000 options and the market is $1 to $1.10, and they bid $1 and they buy 100, they go pay $1.10 and they buy 1,000. They still got to buy almost 19,000 more. So now they're the bid at $1.10. The market now moves from $1.10 to $1.20. Okay, they then pay $1.20. They buy 4,000 there. So now they have 15,000, about 15,000 to buy. Now they're bid $1.20 and they're bid. The market is now 120, 130. So the machine is reading 120, 130 now for a couple of minutes. And then all of a sudden the stock goes down and then the market makers sell 15,000 at $1.20. What is the machine going to say? The machine is going to say that 5,000 traded on the offer, on the ask, and 15,000 traded on the bid. And someone might look at that and say, oh, that was a sale. But if you actually looked at time of sales and you saw what I just, you could see what I just said, then you would see that it was actually a buyer trying to buy $1, trying to buy $1.10, trying to buy $1.20. He wasn't going to buy more. Then the stock came off and then the market maker sold it. The initiating trade was a buyer. So that's where you have to be a little bit careful on bid ask. I use this as a last resort to sort of determine, okay, this confirms this. You see this IV? I want to make sure that the IV, that's really what I'm looking at first, right? I'm using the IV there. And then if I want, I could try to confirm, eyeball this and say, oh yeah, it was on the offer. More was on the offer. And so I'm on the right track. It was a buy. Does that make sense?
Yes. Yes.
Okay. So that was a good question. Yes. So this is my last resort. This is my first resort. I then might look at sort of the ticks and how things are trading. And then this sort of says, okay, I think it's going up. So that means there's a buyer. It's trading on the offer. That's a buyer. And this, the story here is that he looks like he was trying to buy him right out of the gate early in the morning, paying up.
Okay.
All right.
Great. And to
go ahead.
Understand your first resort, I encourage everybody to go ahead and watch the Robinhood video and also tune in on Wednesday and Thursday when Phil's going to be explaining more about the IV volatility, how that moves, and how you can read more into these types of trades using that knowledge.
Good. Perfect. All right. Sounds good. We'll talk tomorrow.
We'll talk tomorrow. I want to thank you for tuning in. I want to ask everybody to subscribe, and I want to thank Felix for taking his time to explain all of this to us.
All right, good. Thanks, Marco. Be good.